Well, I mean, I think, buying gold anywhere below or close to 5,000, I think still makes sense. I don't think there's significant downside risk. And in gold is 1,500 and the price is 2,000, you're making $500 an ounce. But if the cost goes to 5,000 and you're still at 1,500, right, you're making $3,500 an ounce. That's 7 times the profits on not 3 times. So there should be a lot more leverage is to continue to inflate a bubble. He doesn't want asset prices to go down. He wants the stock market to keep going up. He wants the real estate market to keep going up. The only way to do that is by sacrificing the value of the dollar. And that's what they're doing. And so if we're sacrificing the value of the dollar, why does the world want to hold the dollars? The Biden had, but we have more spending. So we're going to have bigger deficits under Trump than we had under Biden. And so the world could see this. And it's like, all right, well, we got to get out. Low 70s is maybe about as cheap as you can get it. But the other problem you have is that physical silver is getting harder to procure. So the premiums that people are paying now on silver coins and bars, especially low denomination, are higher. I mean, what are we not doing? Because we don't have an unlimited amount of capital. And so if we're spending all this building out this AI infrastructure, what are we not doing? Where's the money coming from?
It is volatile out there. Gold, silver, moving hundreds of dollars within minutes. Without notice, they just drop like water. You see waterfall charts left, right, and center. What is happening in the world of precious metals, but also what's happening in the U.S. economy? We've got a lot of data last week. Jobs report, CPI, or CPI, as some of our guests like to refer to. And we need to dig a little deeper. What is happening? Is the economy really doing well? 15% growth was advertised by the President of the United States. Howard Lutnick was a little more conservative. He said 5-6% is possible, but we all know this is very difficult to achieve. So I've invited Peter Schiff, founder of Schiff Gold, Euro Pacific Asset Management, back to the program. Really looking forward to catching up with him. But before I switch over, hit that like and subscribe button. Helps us out tremendously. Reach our goal of 100,000 subscribers before the end of this quarter. Let's see if we can make it together. So, Peter, thank you so much for joining us again. It's always great to see you. Happy President's Day.
Yeah, thanks a lot. Market holiday today, but happy to participate in your program.
Yeah, really appreciate it. It's fairly calm outside today. It's like not a lot of news. It's fairly quiet on the mining side as well. It's quite refreshing, to be honest, given the backdrop that we've had over the last 10 days, 14 days here. Help us maybe start high level. Like, help us make sense of the volatility that we're seeing in precious metals right now. What's your general assessment?
Well, I mean, you can't look at that volatility without looking at what preceded it. So we had a spectacular rise in gold and silver. The gold rally really took place over a more extended period of time. Really, gold broke out in early 2024 and had a slow and steady rise to 4,000. Then it kind of had a very quick move from 4,000 to above 5,500. Silver really went nowhere as gold went from 2,000 to 4,000, and then finally moved from 3,000 to 120. And in fact, the move from 80 to 120 was like a few days. So I think once silver broke out above 50, that was both a psychological and a technical overhead resistance going all the way back to the Hunt brothers in 1980. So I think once that happened, a lot of money came into silver, came into gold, and silver obviously got ahead of itself. The exchanges came in several rounds of, margin hikes. And I think some of the speculators got caught and there was, a lot of volatility. People got forced out of positions. A lot of weaker longs might have bailed out. You saw the media talking about a silver bubble, which, bubbles don't form over a matter of days or weeks. It's something that forms over a much longer period of time than that. But I think a lot of people may have been scared out of the market who recently got in. Maybe other people were motivated to take profits, hearing all of the talk of a bubble, and the bubble's popped and the market's going to go down. But I think the volatility makes sense given the move that preceded it. I think it's a huge breakout in silver. I think silver prices are headed substantially higher from here. I think a lot of this volatility will ultimately, go away, and I think we'll see a far more orderly appreciation of silver, maybe something more similar to what was going on with gold up until the recent volatility. And I think the bull market in gold is going to persist. Gold is only about 10% off its highs. So, nothing like silver down 30, 40% from its highs. So it's just a normal correction in the a silver in the gold bull market. But I think what happened in silver is a very rare event, but it coincides with something that was also rare, which was this massive breakout in silver. So I think it's very bullish for the metals and even more so for the miners. I think the precious metals mining companies are even cheaper. And Wall Street is still not woken up to that reality either.
This is the clearest explanation of what happened in precious metals that you'll hear anywhere. The volatility wasn't a sign of weakness. It was a sign of how powerful the breakout was. Silver had been coiled for decades below the $50 Hunt Brothers resistance. The moment it cracked that level, every technical trader and momentum fund on the planet piled in simultaneously. Then the exchanges did what they always do, raised margin requirements to force the leverage out. Margin hikes are not a sign of a broken market. They're the exchange's way of managing leverage in a fast-moving market. The speculators who got margin called at $120 are not the story. The story is that silver is now permanently above $50, a level it couldn't sustain for 45 years.
Absolutely, yeah. This SILJ versus silver ratio, for example, has dropped to historic lows here, and we'll get to the miners later in the conversation here, Peter, because I'm just trying to emphasize like how healthy or unhealthy that correction is, and to maybe just summarizing what you just said, it sounds like quite a normal move that we're seeing in the precious metals right now. Silver obviously more violent than gold here. Silver crashed per definition. Gold just corrected.
Kai, I don't know that I would say a normal move. I'm just saying that given the abnormal rally that we had and breaking out of such massive overhead resistance, it's not to be unexpected. It's not like, oh my God, look how much silver went down. Yes, but you can't look at that in a vacuum. You have to look at how much it went up and, right before then. And even when you're talking about, oh, silver crashed. Okay, but where did it crash from and where did it crash to? Because, if it's crashing into the $70 an ounce level, that's not a crash, other than for the people who happen to buy it at 120, which, was only one day. The vast majority of my clients who have been buying silver from me for 20 years, I started selling my clients silver under $5 an ounce. So for my clients, $70, $80 silver doesn't look like a crash. It looks like a really good price.
Today's sponsor, Stellar Gold, is sitting on 3 major Canadian projects. Tower and Colomac are among the largest undeveloped gold sites in the country. Tower alone could be worth $2.5 billion after tax at $3,200 gold, according to a recent study. And if prices go higher, so does its value. Colomac spends over 1,000 square kilometers of greenstone and could be Canada's next big gold camp. They also have Hollinger Tailings, a cleanup project that could deliver near-term cash flow. Across all projects, they've drilled over 16 million ounces of gold, which would cost over $2 billion to replicate today. And with a seasoned team and huge upside potential, Stellar Gold is one to watch. Visit stellargold.com to learn more. This message is for informational purposes only. It's not investment advice. Please do your own due diligence before making any investment decisions. Now, let's jump back into the conversation. Absolutely. No, like we're complaining at a very high level here, right? So just try to put some context around it, of course. Peter's like in a lot of trading or a lot of selling has happened actually during U.S. trading hours. Like we see gold and silver tick up during Asian trading hours. U.S. opens and the prices close lower. China is closed this week. What do you make of that? Do you expect lower prices, and where do you see perhaps a floor for gold and silver?
Well, I think it makes sense because obviously gold is under accumulation in the East and the selling has been coming from the West. And I think the East has it right. I think China is correct that buying gold is the right thing to do, and that the price is going to go higher. To the extent there are speculators in the U.S. that don't get this, and that want to short gold and silver, or who want to sell the gold and silver they have because they think it's some kind of a bubble, I think they've got it wrong. And I think the buyers have a lot more dollars that they need to convert into gold and silver than the speculators can short, as far as their ability to short and sell gold and silver that they don't own and have no ability to deliver.
Absolutely. No, it makes sense. And we've seen that trend, for a number of months now. 15 months of Chinese central bank buying, for example, is a constant reminder.
But it's not just Chinese central banks. There's a lot of other central banks that are buying. And there's private demand that is growing, not just around the world, but you're now starting to see some private demand in the U.S. So it's picking up all over the world.
This East versus West dynamic is one of the most important and underreported structural features of the current gold market. The Asian bid isn't speculative. It's strategic accumulation by central banks, sovereign wealth funds, and high net worth individuals who understand what dollar debasement means for their reserves. Western selling, by contrast, is largely speculative. Futures traders, momentum players, and ETF investors who bought the move and are now taking profits or getting margin called. The key insight: the buyers converting actual dollars into gold have far more purchasing power than the short sellers who are selling contracts they could never deliver. Every time Western speculators knock the price down, Eastern buyers use it as a buying opportunity. That's what a structural bull market floor looks like.
100%. Yeah, people are worried. The debt bubble we can talk about here later as well. Just the macro picture hasn't changed at all for gold and silver, right? But the question, though, is how should serious investors approach this now? Is this a buy the dip opportunity? Should we wait for this to play out? How do we frame this moving forward? If you're new to the space, for example, because the recent price hike or explosion has brought in a lot of eyeballs, how would you handle this now?
Well, I mean, I think, buying gold anywhere below or close to 5,000, I think still makes sense. I don't think there's significant downside risk. To me, gold is acting around 5,000 the way it acted around 4,000, the way it acted around 3,000. But also, buying gold at 5,000, you're getting it 10% below its high. So that is a decent correction. Does it mean it can't go to 4,900 or 4,800 or 4,750? No, it doesn't mean that. But who cares, right? If you're buying gold as a long-term store of value, it doesn't matter if after you buy it, it gets a couple of $100 an ounce cheaper. In fact, you could always buy more. As far as silver, I expect more volatility. So silver, as we're talking, is just below 76. Yes, it could easily fall below 70, and so you'd be down close to 10% on paper if you bought some here. But again, I wouldn't worry about it. I don't think silver's going back down below 50. In fact, I don't even think it's going to get anywhere near 50. So I think we're not that far. Maybe the upper 60s or low 70s is maybe about as cheap as you can get it. But the other problem you have is that physical silver is getting harder to procure. So the premiums that people are paying now on silver coins and bars, especially low denomination, are higher. So even if silver goes down $10, it doesn't mean you'll be able to buy it $10 cheaper if you actually want physical. So you've got two things working there. You've got, the scarcity of the physical metal. Yeah, if you want to buy a futures contract, you may be able to buy it, but buying a futures contract is not the same as getting metal delivered to your door, which is what we're doing at Schiff Gold. So I just tell people, just buy whatever we got while we have it in stock, because I can tell by what's happening in the market that we're going to run out at some point. It's going to be hard to get silver, real silver, because I think there's been a big disconnect between the paper market and the real market. And eventually that's going to resolve itself with the futures moving higher. But in the short run, the futures price could do whatever it's going to do, but the physical market is limited by the actual supply of deliverable silver and the demand for that silver, which is growing, not just by investors, but by industry that needs silver. So if you're making batteries and the batteries need silver, you can't just buy a silver contract. You can't put the contract into your battery. You got to actually have real silver delivered to you. So you have to buy it in a physical market.
This is the most actionable segment in the entire interview, and the one retail investors need to hear most clearly. Peter is not saying wait for the perfect bottom. He's saying the physical market doesn't care about the futures price right now. If Schiff Gold, one of the most established precious metals dealers in the U.S., just had their busiest month ever after years of slow business, that tells you something profound about where we are in this cycle. The paper price can be manipulated down by short sellers for a few more weeks, but the dealer can't sell you silver he doesn't have at a price that doesn't reflect scarcity. The divergence between paper and physical is exactly what precedes a violent repricing upward.
Is that, though, more of a supply chain issue within the precious metals space, or is there really a silver shortage? Like, people use that word silver squeeze constantly and maybe misuse it as well, because you have access and you have insights into what's happening on the physical side in the supply chain.
Yeah, well,
is it a supply chain issue or really a squeeze?
Well, it's both, because, there's a constraint on how much silver can come out of a mine. There's only so much the mines can produce. They just can't turn on a new mine just because silver is higher in price. They just can't say, oh, let's mine more silver. Most of these miners were already mining as much silver as they could at the older prices, but also has to do with the refiners. If they run out of inventory, they can't magically transfer bullion into coins and bars, the raw silver. So if all of a sudden there's a big increase in demand by investors, they just don't have the capacity to immediately supply it all. So you get a backlog and you get delays. Then obviously people will start to pay more money for a more immediate delivery of their metals. So all these things are happening. I can tell you at Schiff Gold, business was very slow for the last several years. It just picked up a lot in the last month to the point that we've never been this busy. But to go from a very slow, environment to all of a sudden busy, well, you don't have the manpower. You don't have the resources. You're not used to it. All of a sudden there's a big increase. And that's not unique to my company. Obviously, it's happening all over the industry. So, yeah, we've hired some more people. We're ramping up to deal with it. But, there's going to be problems throughout the entire distribution channel when all of a sudden there's a lot more demand for the metal.
This supply chain explanation is what separates informed precious metals analysis from the noise. A silver squeeze isn't a Reddit meme. It's basic supply chain economics playing out in real time. Mining is a years-long process. You cannot increase silver output in response to a price spike the same way a factory can increase widget production. The pipeline from ore in the ground to a silver coin in your hand involves mining, crushing, refining, fabricating, and distributing, and every single step has a capacity ceiling. When demand spikes 10x in a month, as it apparently did at Schiff Gold, every bottleneck in that chain gets exposed simultaneously. The premium you pay above spot price is the market's honest signal. The paper price is not real.
Absolutely, yeah. As you said, you can't ramp up, and I hear the U.S. Mint is usually not the best producer, especially when it comes to the American Eagle. They're lacking behind massively as well. So, been hearing those rumors for quite a while now. Peter, you touched on the miners, and we need to talk about them. Big opportunity here. They have been lagging the precious metals for a while. Caught up. Now the precious metals have dropped. What's the situation here for the mining companies? Is there still room to run, and what's the opportunity here?
Yeah, there's a lot of room. Wall Street has pretty much been skeptical of the gold rally ever since 2000. So the whole time gold was going up, Wall Street was expecting it to go down. In fact, if you go back to early 2024, when gold was at 2,000, major banks that cover mining companies were putting seller recommendations on Newmont and Barrick. And the rationale was gold has peaked at 2,000. There's no upside. And so why own these miners when all that's going to happen is the price of gold is going to go down? And so these companies have never really reassessed that bad conclusion. And so they've watched gold prices more than double since that forecast, right? And even though the gold stocks have, let's say they've tripled as gold went from 2,000 to 5,000, and that's a little bit more than the increase in the price of gold. One would have expected a lot more than that, given the magnitude that $5,000 gold has on their earnings. Your earnings don't just triple when the price of gold triples. Your earnings move up by a much greater factor than that. If your cost of mining gold is $1,500 and the price is $2,000, you're making $500 an ounce. But if the cost goes to $5,000 and you're still at $1,500, right, you're making $3,500 an ounce. That's 7 times the profits on not 3 times. So there should be a lot more leverage because these companies are inherently much more valuable today. But it's not just that gold is at 5,000 today. It's that it's going to be much higher tomorrow. Wall Street still doesn't get that gold prices are going to keep rising. Not only are gold prices not going to fall, they're going to keep going up, which means the earnings that are already not being properly, attributed to these companies and valued are going to go even higher in the future. So I think you still have a great opportunity to buy these companies. And in fact, some of the best opportunities are in the juniors, the real juniors that haven't even moved as much as the senior stocks. And there, the opportunities are incredible because I think a lot of these small companies are just going to get bought out by the big companies that have massive cash flow now. What are they going to do with all their money? I mean, they could jack up their dividends a lot. They could buy back a bunch of their own stock, or they could try to accumulate more reserves so they have more gold to mine. And the easiest way to do that is buy up smaller companies that have a lot of reserves, proven, but that don't have the cash to develop them, and just buy up those reserves and just, put them on ice, or, you don't even have to develop them now. Just hold on to them because you don't have an infinite supply of gold. So, just keep them for the future because the gold's only going to get more valuable. The longer you wait to mine it, the more it's going to be worth. So some of these smaller companies may need to mine the gold now because they have obligations. But if the big companies buy them up, they don't need to mine it. They'll just throw it in there and it'll just be valued as part of their reserves. They got more operating cash flow than they know what to do with right now. They've never been making money like this. So, we've got a lot of these small companies in my gold fund, the Europe Pacific Gold Fund. EPGIX is the ticker, the no load symbol for the fund that you can get at any discount broker. And we have separately managed accounts at Europe Pacific Asset Management that focus on the mining companies. And we have other strategies, just our dividend payer strategy, for example, just owning foreign dividend payer stocks was up, I think, 62% last year. It's up about 13% this year. So crushing the U.S. stock market. But obviously, the mining focused strategies have done even better than that. But now I think it's still a great time to get into my fund because of the big position that we have, about a third of the portfolio in these really small stocks that would be hard for any other fund to buy now in that kind of size, given the type of liquidity. But I think there's some tremendous performance that we're going to get in the future based on this portfolio that people can take advantage of by buying into it now.
Absolutely, yeah. As you said, like gold price, for example, Q4 average gold price, I think, Nico, I got it right here. It was a $41.63 per ounce realized price in Q4. And as we just discussed ad nausea, it's like we're at close to $5,000. It's almost $1,000 higher within 6 weeks.
Yeah, and what people also don't think about is the cost side of this, because the costs have been a big problem for the mining companies until very recently. oil is barely over $60 a barrel. That's cheap, in relationship to where it's been in the past. I mean, oil's been over 100 when gold prices were a lot lower than they are right now. So that's the main cost in mining. I mean, you've got wages, and then you've got energy. And energy is generally number one, and maybe wages number two. And the wages are not up that much given, where the dollar is right now. If you look at the Canadian dollar, the Australian dollar, some of these South American currencies, they're still relatively low compared to where they've traded against the US dollar in the past. So the operating costs are low. And another thing that people don't consider is that silver is a byproduct of mining gold. And almost all the gold mining companies mine some silver. They also may mine some platinum and other precious metals. And what the money they get from mining silver doesn't show up as earnings. It just shows up as reducing their costs. So their cost to mine gold goes down if they get more for their silver. So if they're selling their silver at $80 and they used to sell it at $30, that's a lot of money. So that lowers their costs. So you're going to see not only the top line going up, right, but the costs going down. So the margins are just exploding for these gold miners.
This is the most important financial insight in the entire interview, and possibly one of the most overlooked opportunities in the current market. The earnings leverage math is staggering. If it costs $1,500 to mine an ounce and gold was at $2,000, your profit was $500. Now at $5,000, with the same $1,500 cost, your profit is $3,500, a 7x increase in earnings on a 2.5x increase in the gold price. Yet the stocks have only roughly tripled. That means even after the big run, the stocks are still undervalued relative to their earnings power. And Peter's point about silver as a byproduct is almost never discussed. When silver goes from $30 to $80, the gold miner doesn't report extra revenue. They report lower costs. Their all-in sustaining cost per gold ounce drops because the silver credit has expanded. The margin expansion is happening on both sides simultaneously.
100%. And I'm here for it as well. So absolutely. I can't wait for that to happen. And price moves have already been fantastic in my portfolio. I can't complain. Right. Peter, you have a lot of confidence that gold will go higher. I think we need to work through that just a little bit, explain to our audience who might not be following you as closely as others. What is driving gold higher right now? Where do you get the confidence that even from $5,000 we could be going higher? What are you seeing out there that makes you say that?
I think it's inflation, de-dollarization, which is a function of a loss of confidence in the U.S. in its ability to honestly repay its debts, in the independence of the Federal Reserve, in the Fed's commitment to maintain the dollar's value or fight inflation. I think, markets are coming to terms with the reality of, $38 trillion national debt rising, in perpetuity by 2, 3, 4, 5 trillion a year. Who knows? You've got Donald Trump wanting lower interest rates, putting pressure on the Fed to lower rates because we need lower rates, because we can't afford to pay the rates because we have so much debt. Donald Trump's main goal is to continue to inflate a bubble. He doesn't want asset prices to go down. He wants the stock market to keep going up. He wants the real estate market to keep going up. The only way to do that is by sacrificing the value of the dollar. And that's what they're doing. And so if we're sacrificing the value of the dollar, why does the world want to hold the dollars? The world doesn't want to be sacrificed. Foreign central banks don't want to hold a currency that's going to depreciate as a reserve. So foreign central banks are moving from dollars to gold. International investors are doing the same thing. And, Americans are going to be doing the same thing. It's going to be a mass exodus out of U.S. dollars into an alternative. And gold is the most viable monetary alternative. I mean, for banks, it's really the only alternative. Private citizens, they could buy stocks, they could buy real estate, they could buy other things, but gold and silver are going to be a big part of what investors buy when they want to get rid of their dollars. And that is going to continue. There's no end in sight to the deficit spending. The Republicans have no stomach to cut government spending. They refuse to do it. They may criticize deficit spending when the Democrats do it, but the minute they have control, they do the exact same thing. Look at the big, beautiful bill that the president brags about signing. They criticize all the spending under Biden and say that's why we had inflation under Biden. Yet when they had an opportunity to cut back on the Biden spending, they not only didn't do that, they preserved all that extra spending and then added to it with extra spending of their own. And then they cut taxes. So we have less revenue than Biden had, but we have more spending. So we're going to have bigger deficits under Trump than we had under Biden. And so the world can see this, and it's like, all right, well, we got to get out. And plus we've weaponized the dollar both under Biden and Trump. We use it, to bludgeon people with sanctions. And the world doesn't like this. And now, Trump is out there chastising the world, criticizing the world. We're entitled to low rates. You guys, and you're taking advantage of us. You're ripping us off. So we're going to put tariffs on everything. We're angering a lot of our allies. And then we're, threatening to invade them. Trump was talking about invading Greenland. He eventually backed down. But the fact that he even put that out there and suggested that it was something that we were considering, I mean, why the hell does the world want to subsidize that? If we've gone from being the protector of the world to being an aggressor to saying we can take whatever we want if we think it's in our interest to invade your country, we're just going to invade it. I don't think that's something the world wants to subsidize. And that's what they do by holding dollars.
This is the core macro thesis stated with absolute clarity. The dollar's reserve status is not a law of nature, it's a confidence game. Countries hold dollars because they trust the U.S. to manage them responsibly, and because the dollar provides security through U.S. military protection. Peter is pointing out that both of those pillars are cracking simultaneously. The fiscal pillar, a $38 trillion debt growing by trillions annually with no credible plan to stop, a president actively demanding the central bank inflate away the debt. The geopolitical pillar, weaponized dollar sanctions that punish allies, tariff threats against trading partners, and actual invasion rhetoric toward Greenland. When the protector becomes an aggressor and the reserve currency becomes a political weapon, the logical response is exactly what we're seeing. Buy gold.
Absolutely. No, and maybe one thing I want to follow up on and drill down just a bit more is really the Supreme Court and the tariff situation here, Peter. Just picking one of the many topics we could spend hours talking about, but just pulled up Polymarket here, and the Supreme Court rules in favor of Trump tariffs is only a 26% chance. Personally, on this channel, we barely talked about a potential fallout of the Supreme Court ruling against the Trump tariffs. And I'm curious what your take is. What will it do to the markets, and how do we prepare for it based on what you're saying here?
Well, to the extent that the markets already expect the tariffs to be ruled unconstitutional, and they are. So, I mean, if the court rules correctly, they will get thrown out. I think the question is, how will the administration respond? How much of the tariffs will he be able to continue anyway, despite the ruling? That's hard to say. And will the court rule that the funds previously collected need to be returned? So that remains to be seen, whether they'll just say, look, you can't impose these tariffs prospectively. But I don't know if the court's going to rule that everybody who paid a tariff is entitled to their money back. Now, they should be, but I don't know if it's just going to be confined to the party that sued, and that party will get their money back, and that everybody else would have to file their own lawsuits to get their money back. I don't know. I don't know how disruptive it would be on the U.S. government to return all that money. But, I think that to the extent that the court strikes down the tariffs and there is an economic problem, that may have happened anyway, even if the tariffs were upheld, it does give the Trump administration a convenient scapegoat, because Donald Trump's narrative was the tariffs were great. The tariffs were making us rich. We had a booming economy because of the tariffs. Now, all that is a lie, but that's what Trump's been saying. Now, if the Supreme Court eliminates the tariffs, which is actually a good thing, or which actually would make the economy better, right? But let's say the Supreme Court throws out the tariffs and then the economy crashes, which it would have crashed anyway. Now Trump could say, you see, look, everything was great, and look what the court did. The court ruined this great economy that I created. So I think politically it's actually better for Trump if the Supreme Court, overrules the tariffs, because it gives him a scapegoat to blame bad stuff on that would have happened anyway.
This is the most politically insightful moment in the interview, and it's the angle that almost no one in financial media has considered. Schiff is making a cold, logical argument. Trump may actually benefit from losing the tariff fight. The economy has structural problems that predate the tariffs and will continue regardless. Inflation is baked in from deficit spending. Growth is already slowing. If the tariffs get struck down and then the economy deteriorates, Trump has a ready-made explanation that avoids any responsibility. It's the political version of, I had a great plan and the establishment stopped me. Whether you agree with Trump's policies or not, this is sophisticated political analysis that explains why market participants shouldn't assume a tariff loss is automatically bad news for the current administration.
Excellent point. I didn't even look at it from that angle, because I was wondering, okay, what happens? Excessive money printing, if everything has to be paid back. Inflation might make a return 6 months down the road, things like that. I was looking at right?
But that's happening anyway. So, at least, because Trump is going to run against, at least in the midterms, the Republicans are going to run against the Fed, and maybe they'll run against the court. They'll be able to say the Fed screwed it up by not cutting rates enough, by being too slow, and the court screwed it up by rejecting my great tariffs.
Absolutely. Maybe last question, Peter. We're running out of time here, but Kevin Warsh, of course, was nominated. The market was quite surprised to see that name, because he stands actually for something that doesn't really align with Trump's policies or what Trump's asking for. He's more hawkish. He wants to, reduce the balance sheet of the Fed. What do you make of that nomination, and where does it take us?
Well, first of all, I don't know why it was a surprise, because he was always one of the front runners. It wasn't like he was like a dark horse. I mean, he was at least like 20, 30% probability, and there was only like 3 or 4, top choices. So, and I don't remember people questioning him when he was a top choice, saying, why is he at the top of the list? This guy is such a hawk, right? So it was only spun that way after he was nominated. And I think that was deliberate on the part of the Trump administration. I think they gave out those talking points because that coincided with the raid on gold and silver. I mean, the big drop happened. Gold was down $500 on the day his announcement came out. And part of what was motivating the selling was that this was some kind of game changer, that he was a hawk now, and he was going to start coming in, guns ablazing, hiking rates, shrinking, going back to quantitative tightening or some crazy stuff. And look, I think the plan of the administration is to frame this guy as if he's some kind of hawk and independent of Trump, so that when he does exactly what Trump wants and slashes interest rates, they'll be able to say, well, it must be justified because here you've got this big hawk cutting rates, so it must be okay. It must be economically justified. It's clearly not politically motivated. I didn't appoint one of my flunkies. I went and I got this totally independent guy. So, but I think that's all, a charade. I mean, there's no way that Trump would appoint Walsh if he thought Walsh was going to be really tough and be this hawk, because that would make him worse than Powell. Yeah. And the reason he doesn't like Powell is because Powell wasn't easy enough. So he's not going to appoint somebody that will be less easy or, tight. He wants cheap money. He wants rates slashed. And if you listen to what Walsh is saying now, he's saying we need lower rates. Now, one of the things that Walsh says, which is true, is that growth doesn't cause inflation. It doesn't. That, and neither does low unemployment. None of that stuff causes inflation. Inflation is caused by an increase in a supply of money and credit. And what generally brings that about is deficit spending. The more deficits we have, the more money the Fed has to create to cover the cost. And so Trump is running massive deficit spending, which is ultimately going to be monetized. The Fed is already doing that. And Trump is doing what he can to expand credit, whether through it's the GSEs or the banks. And the credit expansion also fuels inflation because you have more money chasing whatever the supply of goods are. And in fact, if you look at the big, beautiful bill, it is all demand stimulus. It's no tax on tips, no tax on overtime, no tax on Social Security. None of that leads to increased investment or increased production. It just means that workers and Social Security recipients have more money to spend, to buy stuff. They don't produce anything more. They just spend more. So it's all going to be putting upward pressure on prices.
This segment is Peter Schiff at his most forensic, methodically dismantling both the Warsh-Hawk narrative and Trump's entire economic framework in one answer. The Warsh analysis is brilliant in its simplicity. Trump fired Powell because Powell wasn't dovish enough. Trump is not going to replace Powell with someone more hawkish. The Hawk framing is political theater designed to give Warsh cover when he inevitably cuts rates aggressively. And the inflation analysis cuts to the core. The big beautiful bill contains zero supply-side measures. No tax on tips doesn't build a single factory. No tax on overtime doesn't create a single new job. It just puts more dollars in workers' pockets to chase the same amount of goods, by definition inflationary. Meanwhile, the $660 billion AI build-out is all